See, sometimes what happens is in the market, you choose not to take a trade, and then exactly on the same day, the stock shoots up like 7 to 10%. Has that ever happened to you? Well, it happened to me a couple of days ago in a stock called as Triveni Turbine. It set up nicely, but it was not convincing enough for me to take an entry into the stock. So I chose not to take an entry. And then on exactly on that day, it shot up like 7 to 10%. Let us discuss this trade. So I was looking at this stock on the close of 10th of October. Okay, today is, as I record this video, today I think is 16th of October. Okay, so I was looking at this stock at the close of 10th of October. See, I have drawn this base, nice base here. And let me show you the number of points in the base: 1, 2, 3, and 4. So there are 4 points in the base, which is the minimum that I'm looking for. 4 points means 2 contractions in the base. Then there are minimum 10 candles in the base because I want at least 2 weeks of consolidation. So you have quite a few candles here, easily more than 10. The high of this candle is 758.05. The high of this candle is 757. So 758.05 becomes our buy price. 758.05. So that's my buy point. I could choose to buy the stock the next day as it starts to go up on high volume. What about the trend? The stock is in a strong stage 2 uptrend. As you can see, the price is above the blue line. The blue line is above the green line, and the green is above the red. The blue line is the 50-day simple moving average. The green line is the 150-day simple moving average. And the red line is the 200-day simple moving average. So it's a strong stage 2 uptrending stock, which is near its 52-week high. This is the 52-week high of the stock. And it is forming 4 points. So that means you have the buy point here. The yellow line, 758.05. That is the buying price. Also notice the volume profile of this stock is extremely good. For any stock which is in an uptrend, normally the step 1 is high volume rally. This is called high volume rally. Step 1. Step 2 is low volume consolidation. See, this is all low volume consolidation. So the institutions are not selling. And step 3 is high volume breakout. So I expect a breakout here. However, having said all this, okay, it meets almost 90% of my criteria. However, notice that the buy point is in the blue zone, not the green zone. Now, the green zone is the first quarter of the base, the top quarter. The blue zone is the second quarter of the base. And the red zone consists of lower half, which means the third and the fourth quarter of the base. Now, after point 2, I want to see good price action in the blue zone or the green zone for 1 or 2 weeks for the base to form properly. Here, what has happened is this candle, the price shot up 11%. However, it is still in the lower half, which is not a good sign. So I need to give the stock some time to consolidate. So I will tell you what I am visualizing here from 1, 2, 3, 4, 5, 6. Point number 5 would become my buy point. So I was not planning to buy the stock here. My goal was to buy the stock here. Okay. I am not saying you can't buy here. I am saying that if you buy, you are taking on that additional risk because between this price, 758.05, and the high of this candle, which is 843. So between 758 and 843, there are those market players who are called as trapped buyers. So people who have bought the stock between 758 and 843 are going to put pressure on the stock because the moment it comes to their break-even price, they are most likely to sell because they have seen the price fall from their buying price. These are called trapped buyers. So when the trapped buyers begin to sell, what you have is overhead supply. Overhead supply means what? The people who want to get out of the stock at break even begin to dump their stock. That's why supply comes and that puts the pressure on the price. The price doesn't go up. Okay. For the price to go up within overhead supply, you need huge volume. Okay. So that is why, since the buy point is in blue zone and there are only 4 points in the base, I hesitated to buy the stock. I said, no, let it go up, let it consolidate more, and then I will take a proper entry, probably in the green zone. If there are only 4 points in the base, but the yellow line is in the green zone, I would buy the stock. However, if the yellow line, the buy point is in the blue zone, I would prefer to have 6 points because I want to see more consolidation. I want to see more tightness on the right side. Here, you still don't see tightness. Here, you see a sudden spurt of 11%. Okay, so it takes a lot of energy for the stock to move up. This 11% could soon get exhausted because, see, if the price went from here to here on low volume. Okay, the volume should have increased on this bar, but that did not happen. So when the price is going up and volume is going down, it means there is weakness in the rally. Okay, so I don't like that. I want good volume coming in for nice 3 4 days and the price going up significantly above the buy point. That's the ideal. Remember the 3 steps. Step 1 is high volume rally, step 2 is low volume consolidation, and step 3 is a high volume breakout. So I was expecting a breakout here, but I did not plan to buy the stock. And look what happens the next day. See, the stock shoots up. The stock shoots up 6.88% immediately on the next day. So I'm watching the stock just before that day, and I take a decision that I don't want to take an entry into the stock because the base has only 4 points. There is no tight price action on the right hand side. Okay. And the buy point is in the blue zone. Okay. If there were 6 points in the base, probably I would have considered, but not here. Okay. 4 points in the base, yellow line in the blue zone. I'm not buying the stock. I would give it more time. So I missed this rally. Okay. I could have taken an entry here and could have captured this. See, even this candle is a bullish candle. If we go to the 15-minute chart, 11th October, let's go to 11th of October. See how simple it was. On this candle, it finally, this is the first candle of the day. This is the second candle of the day. On this candle, the price finally breaks the yellow line on high volume. So the volume is above the blue line on the 15-minute chart. High volume, price closing above the yellow line. And as you can see, if you buy on this candle, okay, after it pierces the yellow line, if it trades one tick above that 758 price, so 758.05, if it trades at 758.06 or 758.10, if it trades at that price, you can quickly put a market order. The price closes on the 15-minute chart above the yellow line. After that, you have 2 follow-through candles, and during the day, the price never closes below the yellow line. That's a true breakout. So the price holds up above the yellow line. That is what we want to see. But unfortunately, I did not take an entry into the stock because I want to see more consolidation. Now let's go to MarketSmith and see why in the first place was I considering this buying the stock. How did it come on my radar? What characteristics is this stock showing so that it comes on my radar? So let us look at that. So let me take you to MarketSmith. So let us type here Triveni Turbine. This is Triveni Turbine, fairly popular company in India. So wait, I'll have to log in first. Yeah, my internet speed has become respectable now. So what I have done is I have removed the Wi-Fi and I have taken another connection and I have directly connected the Ethernet cable to my router. So now the speed is good now for my laptop, sorry, my desktop. See, everything opens very fast. This is fantastic. So I click on consolidated. Let's see what's going on in this company. Okay, so it's a fairly large company, 25,000 crore market capitalization. So it's not some small company. If I click here, see it says stage 2, which means it is base number 2. So buying the stock here would be buying the stock very early in the uptrend. So there could be much more potential in the stock in the coming future, because you have to go through base number 3, base number 4, base number 5. By the time the stock goes from early stage to late stage, it could deliver a triple digit return. You could look at many examples of that in Market Smith. So you see this green dotted line, that's the point that is drawn by Market Smith. So that becomes your buy point. So this is base number 2, which is early stage. As you can see here, double digit growth all around. This is called quarterly EPS growth. Double digit growth all around, double digit growth all around in sales. See, there's hardly red color in the sales and the EPS growth. Okay. So for multiple quarters, the sales and the earnings per share have been growing. How does this number come? You take June 2024 quarterly earnings, compare that with June 2023 quarterly earnings. Okay. And you record the growth. So that's the growth positive. So as you can see, fantastic numbers. So the stock looks fundamentally strong. Management ownership is more than 50%, which is fantastic. The number of funds owning the stock has increased from 228 to 280, which is again very good. The up down volume ratio. So the volume when the stock is going up divided by the volume when the stock is going down, that's the up down volume ratio. It is 5.8, which means when the stock goes up, the volume is 5.8 times more than the volume when the stock goes down, which is a very good sign. Okay. Beta is 1, which means it is almost tracking the market. Book value yield is not important. Master score is more than 60, fantastic. Both EPS rating and price strength are above 80, which is fantastic. So earnings strength is there, price strength is there, fundamental and technical strength is there, accumulation distribution rating, which means institutional demand is there, group rank is 10. So this is the best stock from the best performing industry group, one of the best performing stocks in one of the best performing industry groups, which has got institutional demand, which is near the 52-week high, and which has good up down volume ratio, and which has got good fundamentals. So if everything comes along, okay, you might consider buying this stock here, okay, by taking that additional risk. But as you know, I'm a conservative person. I don't want to take too many risks. See, this is today. So today is 15th of October. This is today's price action. The market is live right now. Okay, so I want to see some tightness here before it breaks out. So I will get a nice entry. See, now the price has entered the green zone. Okay, the first quarter. Now, sometimes what happens is without forming a tight price action, it shoots up and it goes away from me. In that case, I don't bother chasing the stock. I just let it go. Return on equity is more than 17%. PE ratio is on the higher end of the 5-year PE range, which is fantastic. Earning stability is good. The lower this number, the better. EPS growth rate, this is 3-year, 5-year EPS growth rate, which is fantastic. So fundamentally, the stock looks great. Look here, 2017, what was the EPS? 3.74. Now it is 8.47. It's almost tripled. Okay, isn't that fantastic? Okay, that's how you look at a stock. You look at the technicals, you look at the chart, you look at the fundamentals, you look at management ownership, you look at number of funds owning the stock, you look at the stock vis-a-vis the index, you look at the stock vis-a-vis other stocks in the market. In general, the relative strength line has been increasing. The stock is in an uptrend. Everything is in favor of the stock. High volume rally, low volume consolidation, and now a high volume breakout. So I should have taken a position here, but the only reason why I rejected the stock is because I want to see tight price action inside the base, irrespective of what the ratings are, irrespective of what the fundamentals are. I want to see good tight price action either in the blue zone, this blue zone, or in this green zone. Now see that if this candle closes like this, and the next candle is a baby candle. So now baby candle means the high and low of that baby candle is within the high and low of this candle. So if the next candle is a baby candle on low volume, okay, then the high of this candle becomes my new buy point. That too in the green zone. So I will have 4 points in the base, which has got high volume rally, low volume consolidation. I got 4 points in the base, and the buy point is in the green zone. Now I am much more closer to the 52-week high. Here, the overhead supply is going to be much smaller than here. So I am not saying don't buy here. You can buy, no problem. However, you should understand that you are taking that additional risk. Or you could pyramid into the stock. Let's say you want to put 10% in the stock. You could choose to put 5% here, 5% somewhere here. Depends on your personality, depends on your risk taking appetite, depends on your realized gains. You decide what is suitable for you, because position size is a very subjective topic. It depends on multiple factors. It also depends on your age, right? A 25-year-old guy would take a larger position size than a guy who is 75 years old trading, right? So position size depends on a lot of factors, which is why I don't want to discuss too much on that. But you look at the chart, the technicals, the fundamentals, and things like that. I could have taken a small entry into this stock, like a test entry into the stock, and have seen, but I did not do that. But the base is still intact. The uptrend is still intact. The stage two is still there. The stock might tighten up on the right side in the future. And when that happens, I am ready. Okay, I've already done my homework on the stock. So I'm ready. And I know that I am buying this stock early stage. So if I'm buying at stage like base two, that is early stage. So this is a stock where if I get a proper entry on a high volume breakout, I might want to hold on to this stock for a much longer period of time. This is unlike Dixon, where I made a video yesterday. Dixon was in base number three, which was middle stage. So I got out of the stock as soon as I got a double digit return in less than a month. But in this case, if it's a nice breakout, after the breakout, there is good 2, 3 follow up candles, and the stock goes up like 20-25% in 1 or 2 weeks. In such cases, I would give the stock more time. I would just hold on to the stock because fundamentally it looks okay, no problem. Technically, it looks okay, no problem. It is near the 52-week high. The volume profile is great. The price action is great, assuming there is tight price action on the right side. So if everything is in my favor, why should I sell the stock? Because finding a stock with all of these characteristics itself is a challenge. So if I'm getting a stock, I'm not going to let that opportunity pass up. Okay. But just wanted to disclose that I did not take this trade. And I think I should have taken this trade. But given the current market conditions, okay, taking a trade here would have been very risky. Okay. Because in the market, only select stocks are going up right now. Plus, there is this stimulus package announced by China where the money is coming out of India and going into China because they have artificially boosting their economy and the stock market and things like that. So governments do that. It's not just about the Chinese. Governments cut interest rates, pump in liquidity. They do things like that. So the money keeps flowing across the globe, and that impacts certain stock markets. So the China thing has impacted the Indian stock market. Stocks came under pressure. But I noticed that some of the stocks which were showing fundamental strength, they did not fall as much as the other stocks which were fundamentally weak. Okay. So I hope you understood my logic behind why I skipped this trade, why I did not take this trade, because I want to limit my risk. I want to buy the stock when the overhead supply is the lowest. Okay, that's my logic on this. So for that, I am willing to give the stock some time. I'm willing to give away some return. I'm also willing to take the risk that the stock might not form tight price action and continue to go up and never give me a proper buy point. I'm also willing to take that risk. So that is professional trading. Okay. You know what you're getting into, you know what you don't want to get into. And if the stock just runs away from you, let it go. Don't force yourself to take the trade. So if you like the content that I'm creating here, please support this YouTube channel. Already you have been giving a lot of support to this channel. I see a lot of views and watch hours coming in, which is great. So I see that you are studying from these videos. So please like, share, and comment so that this video reaches those people who truly want to become genuine professional stock market traders. I think this content will be helpful to them as it has been to you. So thank you so much. If you have any questions, doubt, just send me an email or put it on comments. Let us discuss this. Thank you so much. So this was an example of a trade which was not taken. Okay.